Investors are starting off on the front foot, both of the Canadian markets and the U.S. markets, on a very catalyst-heavy week that includes Tier 1 economic data, the biggest companies on the planet reporting, and in a week and a half, we've got a major U.S. election that could be very consequential. Let's bring in Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian, I hope you got your rest this weekend, because I don't know if you're going to get much of it for the next 8 days. What should we start with? Should we start with the test of tech and whether they're going to be able to deliver?
Sure. By the way, so wonderful to be on with you. It's been a long time, and good morning, Canada. You know, we've been at BMO now for 12 and a half years, and we've been pretty consistent in our theme with respect to technology, especially the large technology names that we have kind of coined this phrase, they're consumer staples now. And it kind of fits with the consistency of our broader investing theme, quite frankly, that this period really feels like the mid-90s, like 1995, 96, where that market actually was driven by these large cap consumer staples names, the Nifty 50. And we think that those names, meaning the Googles, the Apples, the Microsofts, the Netflix, we think those are the new consumer staples right now, in that investors that are core holders of U.S. and Canadian names should continue to hold those names. And we think earnings are going to be very, very good this quarter.
It's interesting because some have been content to say that trade is over. Look at the 493 on the S&P 500, and that you go from, you know, what you're calling the new consumer staples to the actual consumer staples.
Right. So our broader call has been, our theme has been everybody love everybody, meaning you have to own a little bit of everything. And we're not saying that you should be massively overweight those consumer staple techs. We mean that you should be maintaining positions there. And we've been long-term bulls on small cap, on value, on dividend growth, and we've seen massive amounts of broadening out, Amber. In fact, in the third quarter was the first quarter in 2 years that those Magnificent Seven actually underperformed. And I think that's the broader market that is. And I think that's a sign that the market actually is getting healthier, that it is more like a 90s market. The visual with the 90s is more so that people can kind of pick a theme. I think the traditional consumer staples, like the Kellogg's, the General Mills, the Campbell Soup, the Kimberly-Clark's, the Procter & Gamble's are actually more expensive than the tech stocks, with the catalyst of increasing commodity prices with the inflation that they've been able to pass along the last couple of years no longer there. So I think the pricing power for the traditional consumer staples is no longer evident, and we're actually underweight that sector in both Canada and the United States.
Okay, that's good perspective. And then we've got the Tier 1 economic data, as I mentioned, both the Fed's preferred gauge of inflation. And we're nervous about inflation, Brian, because recent prints have not been playing along with this thesis that inflation is a straight line down. And then I don't know what to make of the jobs picture in the U.S. It's falling off of a cliff in the summer. It comes back with a big jolt over, the last reading. How are you reconciling these conflicting data points? Because you've got to figure out, what's the Fed's next move? How's the bond market going to interpret that?
Well, it's a great vantage point, and thanks for laying that out there. I think what we're seeing is a move to normalcy across the board, whether or not it's job gains or inflation or interest rates. Remember, the average 10-year Treasury the last 75 years is 5%. And we've been, from our investment strategy work, been calling for a 3 to 4% 10-year Treasury range. Here for the last couple of years, our great economics department continues to think the Fed is going to cut into the end of the year. However, we do believe, and we know from our experience, that inflation's not like an elevator, it's more like an escalator. And it's being stubbornly, let's say, higher than the Fed's 2% target, which, oh, by the way, is into next year. So I think what we've done in business here, and especially in investing, quite frankly, Amber, has become so reactionary. Directions aren't up or down. Sometimes they can be sideways and they're not up and down dramatically. And I think investors are too positioned, quite frankly, for a rapid decline in inflation. And what we're seeing here is more normalcy. So I think the Fed's actually done a pretty good job. We would caution investors by putting too much, let's say, ammo into the Fed funds futures market, giving them too much credit. Because remember, a year ago, Fed funds futures said we were going to cut 6 times in the U.S. in 2024. So again, maybe a little bit less, but at the end of the day, the Fed's doing a good job, and inflation is coming down. It's just not coming down like an elevator.
Let's talk election in the U.S. I remember November 9th, 2016. Yours was one of the first notes I read after Donald Trump was elected president, and there was a bit of apprehension in the morning, and I'm pretty sure that day the markets went on to make all-time highs. We have a blueprint for a Trump presidency. In some ways, we have a blueprint for a Harris presidency if it's a continuation of Biden. And the markets are betting that it's going to be Trump. Do you think they're getting it right?
Well, we always say that politics have nothing to do with the absolute performance of the stock market. It really can enhance or detract the current trajectory, and the current trajectory is up. And we think the fundamental condition of stocks in the U.S. is very, very good. Earnings are good, cash flow is good, balance sheets are good. But at the end of the day, people and investors are going to be emotional, as they were in November 9th of 2016. We don't want to react. We want to invest. And so that's why we say control what you can control, Amber. And how do you do that? It's by tilting toward higher quality. And I don't like when people come out and say high quality. What is high quality? It means discernibility of earnings, meaning consistent earnings, the return structure of those companies, whether or not it's return on assets, return on equity, return on cash flow is positive. If you're buying those types of companies in the United States, you're looking at technology, you're looking at financials, you're looking at parts of consumer discretionary, you're certainly looking at parts of communication services. So I think any kind of reaction in any side of the coin, whether or not it's Mr. Trump or Ms. Harris, I think the market can, will, and should probably react. That reaction, if there's a downside reaction, Amber, I think that's an opportunity to buy more stocks and control what you can control.
Now, let me ask you about the bond market. When do you get worried about the sell-off in, let's call it the U.S. 10-year? Why are rates going up when the Fed is cutting rates?
Well, traditionally, the rates actually, the 10-year Treasury does rally after a prolonged period of the Fed not doing anything, which followed a prolonged period of the Fed raising rates. So I think, number one, people lack perspective, and that really notes to the short-termism of investors the last, I don't know, probably really accentuated since COVID, but really began during the great financial crisis. That's the kind of number one. Number two, maybe this is your October surprise. And number three, remember last year rates were raising for different reasons. 2 years ago, in 2022, rates were rallying because of inflation was being sticky. And so the bond market is quite fickle. I think the bond market's noticing that it's probably ahead of its skis in terms of the prior comment that I made with respect to Fed funds futures. But the train has left the station. The trend of inflation is down longer term. I just think that the market's probably, the bond market that is, a little bit oversold here. And we do think we're going to see some stabilization the last couple of months of the year.